Good afternoon, everybody. Welcome to the TraderMerlin Show for your second show of January 2024. We started things on time. I've got it recording properly. I've got no audio issues. It's going to be a perfect show today. My New Year's hangover apparently is now officially gone. So anyway, welcome, everybody. Just so you know, we are doing our forecast for 2024. I have the list here. I've updated it. I have on the list so far 41 people are on that list. Some of you have some pretty crazy expectations. I saw one person has a decline of 26% for the S&P, and somebody else saying, I think it's going to be up 76%. So we've got a full spectrum of expectations about what's going to happen in 2024, but we will have to wait and see how it all pans out. I'd certainly be crazy if I got a 76% market return in 2024. Anyway, as you guys know, I'm doing a series this week and next week, which I filled out our roster for both weeks. We're going to have full shows every week of different traders on the program, giving you kind of what are they looking at for 2024, what do they think the biggest obstacles, maybe even give us some market forecasts. And today, none other than my good friend and chartered market technician, CMT, Mr. Scott McCormick, who's looking very dapper like an FBI agent in this picture. Scott, how you doing today, my friend?
Good afternoon. Doing well. Happy New Year to you. How are you?
Good. It's been a while since we've had you on. I liked our monthly visits, but I think we're going to go bi-monthly now. So glad to have you back on the program. Do you do anything fun for New Year's? I know you're the beacon of excitement when it comes to holidays.
I think I'm putting my celebration activities off until this weekend. I'm actually going to a Pink Floyd laser light show.
Oh wow.
Yeah. So I'm.
Did you need some? Are you taking hallucinogenics? I mean, that'll be a fun one.
That would add to it for sure.
Yeah, nice. I've actually done the Pink Floyd Laserium show up in San Francisco years ago, and whew, man, great. Especially if you like the music, it's a great show.
I love Pink Floyd.
Good. All right. Syd Barrett, the Syd Barrett days?
I think the furthest back that I go is the album Metal.
Okay. That's a great one. I love metal. I love Animals. Saint-Tropez is one of my favorite songs. Anyway, we're going into a music show today. Talk to me about 2024. One of the things I'm going to kind of try to do is keep standardized questions so everybody kind of gets the same. I could give their 2 cents on it. First one I'm going to ask you is, what is your biggest concern for 2024? As as the year unfolds, there's so many different things from inflation to interest rates to GDP to printing of money in the bond market, and what is it that you think, at least for your style of trading and investing, is going to be the biggest challenge for 2024 for you?
So one of the biggest lessons that I've learned throughout the years is to remain in the moment as best as possible and remain as flexible as you possibly can. And what I mean by that is that although themes present themselves throughout the years and throughout a year, I mean, obviously this past year we had year and a half, we had the inflation battle, Fed raising rates, and now of course everybody's talking about rate cuts. And my attitude is just bring it, right?
Yeah.
Just love it, because I don't know necessarily what the market is going to do or how it's going to react to this information until it does. And once it kind of shows its hand, then I'm better able to kind of play the market. And so the way, I guess for some folks, they would probably better understand it as playing a game like Texas Hold'em. Like once some of the cards actually get down on the table, you have a better understanding of the probabilities of the hand that you're playing and whether or not you should actually continue to play that hand. Like for instance, in the last couple of months here in 2023, we had a return in the span of 2 months that most people would wait an entire year for.
Right. 2 years. I mean, that return, I'm mapping it out for you. So if you want, you can just mention numbers. You look at the average annual return for the S&P is 8 to 10%. We rallied in that 42-day window between October 27th and December 28th. We rallied almost 17%. I mean, it's like, holy cow. Things happen. You just got to be ready for
them. And that's exactly right. And so at the end of the day, I always look at things through the lens of technical analysis. And for right or wrong, I know that there's individuals out there that are very hardcore fundamentals, technicals don't matter, and then you have the other end of the spectrum. My attitude has been for quite some time that you have to look at what the market is doing right now, and based on that information, what's the higher probability approach here that we need to take. So to kind of get back to your question, what's my biggest concern? My biggest concern necessarily isn't a theme necessarily. It's whether or not we do manage to get above those 2022 highs, right at the very beginning of the year where the market did top out. So we saw the Dow, we saw the NASDAQ actually make new all-time highs going into the end of the year. They obviously pulled back in that last week. The Russell finally managed to get out, at least on a daily closing basis, above the range that it had been in for nearly 18 months.
I know, crazy.
Only to move back into that area again here in just the last couple of sessions, especially today. So there's the possibility that we could see some short-term weakness within the equity markets. But I think if I did have to put kind of a macro theme on things, I do think that it's going to be the bond market. What are interest rates doing? What's the Fed doing? Because that's almost always going to be the case. But I think we're in a place right now where it's a much more kind of heightened situation, if you will.
So in kind of circling back to that question, what's your biggest concern for 2024? You mentioned, the S&P maybe getting above those highs. I don't know if that's necessarily a concern, but just something you're looking for. It sounds like it sounds like what you just mentioned, that your big concern is the bond market. Like it's the biggest wild card and unknown that's going to drive the markets. Is that safe to say?
I would think so. The other thing to consider as well is that we are in a presidential election year.
Yep.
And statistically, they tend to be positive years. So if I had to throw some numbers behind the equity market, like what would I expect? It's my opinion right now that when we put in the lows in October of 2022 and began this upward trend from that period in time, we're beginning the next impulse phase, right? So if you ask me like what long-term target do I have on the S&P 500, my longer-term target is around 6118, right? Let's just call it 6120 on the S&P.
All right.
And which isn't, that's not too far out. Like when you think about the percentage change from current levels, it's about a 30% move, which that's a really good gain, but not out of the realm of possibility. So for instance, when we look at the rally from the March lows there in 2020 going up to the highs in January 2022, that was a 119% rally. And even the rally here from October of 2022 to the highs that we saw in the summer before we went through that retracement during September, October, November, or I should say August, September, and October, that was a 31% rally. So to see a 30% rally from current levels, it's not out of the realm of possibility. So if you had to hold my feet to the fire, I'm still fairly bullish on the market overall. Is it going to go up in a straight line like it did for 2 months? Doubt it. I would actually expect to see a bit of a decline here, possibly even just coming back to the highs from July of this past year, where we actually broke out from in December. And so when you take a look at like how big of a decline that is from the highs that we made there in mid-December, that's only about a 4% decline. So
5 if you're lucky, 4.5. I mean, and honestly, that would be considered a bad day. We've had 1.5% moves. I mean, today the Russell's down 2.7%. I mean, okay, that's not that big of a deal. Yeah. I remember years ago, you hear like a 4%, you're like, oh, that's a huge move. Now it's like, well, that was a big day, but not that big of a deal.
Yeah, I agreed.
All right, so biggest concern for 2024 seems to be kind of the looming pressure from the bond market. There's, could go a lot of different ways, and I like what you said at the very beginning. You said one of the big things, you took that comment initially, what's the biggest concern? You internalized it. For you, it's just, I got to make sure I remain flexible and go with whatever that market gives us. Now, obviously, we've been on this beautiful uptrend, and I've been drawing on the charts along the way as we go, not only from those lows starting back in September of 2022, but also since that, ballistic move from our October lows. When you look at all these different factors, and we could spend hours, you and I, going over all the different information. Bond market's the big one, and I look at things from, I guess, a bit more of a macro perspective because of my my addiction to Bill Addis's teachings about the bond market. Yeah. He has certainly given me some interesting perspectives. With the expectation that starting next May, we're going to start to see some rate cuts. How does that play into your assessment of market direction? Because obviously rate cuts act as a catalyst for the markets, and I'm not fully committed to believing we are going to see those rate cuts next year. I know the markets are pricing them in. If inflation steps back up, that might be paused yet again. But I guess I would ask, how do the rate cuts or the Fed's actions influence you and your approach to the markets?
So one of the interesting things about my experience with the Federal Reserve is that when I started in the industry, I started back in the year 2000. So my hire date was May 15, 2000. And the Fed entered into a series of cuts over the course of the next year or two. And every time they would come out and they would cut interest rates, the market would rally for a day or two, but then ultimately we would begin to see lower lows over the course of the next couple of weeks, month, what have you. So what I learned is that, at least in that environment, which at that period in time was actually more disinflationary, which is counter to what it is right now. Mm-hmm. But in a rate cutting environment, the way that I internalized that action is that the reason why the Fed would actually cut interest rates is because they see a weaker economy and they're trying to stimulate that. They're not cutting rates because, they see that, the stock market is not doing as well as what it did. So let's go ahead and cut the rates and get some buyers back into the market. That's not the way that it works.
That's not the way it's supposed to work.
I mean,
in a perfect world, we know it's a dual mandate, right? We know it's full employment and stable prices. But let's be honest. I'm pretty sure deep down, if you could plug into Jerome Powell and the FOMC's brain, it's like, shit, we got to get this market back on track, because if we don't, no one's going to get back in their positions, and we got to help retirees with their 401ks. So come on, we know that indirectly they do want the markets to go up.
If I were to take a diplomatic approach here, I would say that there's probably an underlying sense to maintain confidence in the equity market.
There you go. You are ready for office, my friend.
So that said, if we did start to see that the labor market started to soften a little bit, I think that would at least curtail their hawkish stance, and maybe in a year you would probably start to see a little bit more of a dovish stance. Now, over the course of this past year, what's kind of interesting is that when you look at how the equity market rallied over the past year, a lot of the sectors were actually held back. And it's only until recently that we're starting to see strength in some of the areas like commercial real estate and financials in particular, to help kind of broaden the extent of the rally. And those were two sectors in particular that actually helped to push the market to the highs that it did. Of course, we have to couple that with technology. But right. When I look at the equity markets, one of the things that I tend to focus on is what is the weighting of each of these sectors within the S&P 500, so that I can get a sense as to how the market might perform based on the performance of those underlying sectors. So when the market was going up the way that it had been during, let's say, the second and third quarter of this past year, there was reason to be a little tentative, just because it wasn't a very broad-based rally in the markets. It was primarily driven by information technology and, of course, AI and everything. But now we're starting to see, over the course of the past, I'll say the past 2 quarters, we're starting to see broader participation, which is giving me a little bit more confidence in the market. So to tie that back to the Fed, if I'm seeing broader participation within the market, then there's less motivation, if you will, to cut interest rates that quickly. Because if they were to cut interest rates in a really strong environment, then you're just going to kind of spur that inflationary market bubble again.
Right.
And then, of course, those that study history know that inflation actually has a bit of a cycle to it. And you can dig through the Twitter sphere and so forth, and look at some of the posts that people have made over the course of this past year about how the inflation that we saw last year was only the first leg. We have another leg to go. So I think that, again, flexibility is going to be key in this coming year. So
yeah,
go with the current trend, but be prepared to protect yourself if needed.
Let me show you guys a couple graphics here to support what Scott was saying. If you look back, these are the 11 S&P sectors, and this is the full, trading year, like basically 252 days going back to January 3rd of 2023. And it's interesting when you look at this because, if you were to look at this picture of the equity markets here, this is the chart of the markets, and here is what happened over the course of 2023. There's your full trading year. You look at this and you go, damn, markets were good. I mean, we had a great rate of return. If you go to where we peaked out at, you're looking at, actually that's a little bit more than expected. Let me go here to a number here. If I go from December 30th of 2022 to where we ended the year, you're looking 25, 26, 27%, somewhere in that ballpark. So you think it all does it's looking great. And that, to me, that's an excuse for the Fed to have a lot more flexibility. But when you look at what Scott was talking about, which is critical, and it kind of goes into my next question here, you notice there's really only 3 sectors that have been carrying the market. You had discretionary was up 11.39%, communication services 24.49%, and then the big daddy was technology at 26%. Everything else, industrials, materials, energy, staples, healthcare, utilities, financials, real estate, all not only negative, but everything in there was double-digit negative. Utilities leading the sell-off at 30% slide, staples down 25%, energy down 19%. So a lot of this reflecting that it isn't a party and euphoria for all market segments. It's actually showing a lot of pain in the broad markets. Now, what Scott mentioned is if you go back to the last 6 months, and I'll go back here, let's say roughly 112 days, it's certainly still showing weakness in 2 big sectors, number one being staples and utilities down 7%, but it's starting to show a little more stabilization. Now, if I go closer, let's say the last 30 days, you notice everything's been looking really good. Really only a couple things have been pulling it down. But you'll get these ebbs and flows of what's pulling the market up, pulling the market down, and I think that there's opportunity in that, not only with the market segmentation of the S&P, but also, as Scott points out regularly, in the commodity markets, cotton and wheat and soybeans and silver and gold and all that stuff. All of these have their day in the sun, and I think it's important to kind of look at what signals they're giving us and see what the opportunities may lie there. So anyway, had to share that graphic with you, everybody, Scott, because it's very interesting to look at that and see how poorly the overall markets perform. Even though they showed up, it's because of Apple and Microsoft and some of the bigger companies in 2023. Now they're the ones bringing things down in 2024, at least to start. Did I lose you, Scott?
Oh, sorry. I muted the microphone. And,
no worries.
Sorry about that.
Is the cat fight going on? Is that why we didn't want to hear the cat?
No. I've sent them to their corners. But going back to something that I said a little bit ago about the construction of the index, when you look at how the S&P 500 is broken down, information technology as of the end of December represented 28.9% of the S&P 500. Wow. When you look at the next largest sector, that is financials, and that comes in at 13%. So when you consider how much larger the representation of information technology is versus financials, it's more than 2 times as much, right?
Yeah.
And then the next sector would be healthcare at 12.6, and so that's pretty close to financials. But the point here is that it's not evenly weighted. And when you start to look at, let's say, the top half of the index in terms of weighting, those sectors are information technology, financials, healthcare. We have consumer discretionary and industrials, which has actually moved up the list. And to me, that's a positive sign, because industrials have kind of been underperforming as a sector for a while, but over this past year, it's managed to make some all-time highs, as the sector ETF anyway. But when you look at those top 5 sectors, that represents 73% of the S&P 500.
Wow.
Right? And
Yep.
so when you look at the less weighted areas like consumer staples, energy, real estate, materials, and utilities, those could go gangbusters, right? But they wouldn't have the impact on the market that the top half does. So looking for strength and weakness in the market is going to be pretty important. And this is why, talking about like broader participation, I think is a pretty key theme. And kind of going back to your very first question, what would be a major concern of mine is seeing the relative strength within the information technology sector actually begin to deteriorate. It did pretty well there this past year, and it made a new high going into November, and barely made a new high in December as the equity markets were rallying. But going into the last week of December, we actually did see some weakness. It's only the relative strength ratio itself is just kind of breaking back or retracing back to an area where it broke out in early or late October and November, when we saw that rally really start. So not too concerning yet. The overall trend is still up for the relative strength, so still hopeful.
Right.
But yeah, so and looking at financials, that has actually started to show signs of strength. So that earlier in the year, last March, I believe it was, when we started to have all of those issues with the banks.
Right.
I'm not going to say that we're completely out of the woods there, but you're seeing a sentiment change in the financial sector over the course of the past few months here. And because we had some relative weakness within that sector going into June, but since June we've actually developed an uptrend. So that's a positive sign. So if we can keep at least those top 2 sectors kind of doing what they've been doing, then I wouldn't be surprised to see the S&P 500 make an all-time high this year.
You are much more of I would say, a focused student of some of the market internals than I am. And when I was looking at this graphic here, and the weightings may have shifted a little bit due to time, but obviously technology is the number one weighting in that S&P 500, and followed by financials. How does this shift historically? Right now over 50% is in healthcare, financials, and technology, at least based off the graphic I have. If you've been looking at this longer, how often do you see these slices of the pie, if you will, of those 11 components really shift, and utilities become much more relevant? Or is it relatively consistent that technology and financials and healthcare are kind of the biggest ones? Does it shift? And if it does shift, are you concerned that maybe technology is so influential in the overall markets?
It does shift over time, and I'm sending a link to you for the S&P global breakdown,
Okay.
where the data comes from. This information is updated at the end of every month, and so if you were to go back, for instance, and look at, let's say, the market top in 2000, I think anybody would know that, yeah, your largest sector at that point in time was information technology. If you go back into 2006, 2007, the largest sector was financials. But over the span of time, these things do kind of make and lose rank throughout the course of the year. The changes that they make are very incremental. So for instance, like industrials has been working its way up the list over the span of this past year. Currently, it's 8.8% as of the end of December, but maybe, let's say in October, it was 8.6%. And let's say in June, it was 8.5%. So these changes are very small. Information technology earlier in the year was probably in around 27%, but if I'm not mistaken, at the end of November, it was as high as like 29, almost 30%. So again, the changes that they make are very small, but very influential over time. And because this is information that's updated monthly, it's important that if you're looking at this, you maintain more of that longer term perspective. You're looking at the market cycles that tend to exist over the span of, let's say, 4 to 5 years, not, what's the hot sector this week or this month.
Where did you send that link to? I haven't gotten it yet.
I'm sorry, it was in the chat and
Oh.
Zoom. Yeah, or Teams or whatever we're on.
We're on Zoom. Yeah, I wasn't. Your video is minimized because you never share your video. We've got people who are like, I want to see Scott. And I'm like, he doesn't want to.
No, you don't.
We do. We want to.
No, you don't.
All right. Well, I'm trying to find it. Let's see. There it is. And where is the damn chat? Excellent. Hold on. I'm going to bring it up here in just a second, everybody.
Sure.
For some reason, it's not allowing me to bring up my chat panel. There it is. Okay. I'll share the link with the viewers out there as well if you would like. 1 second here as I bring this one up. And I will copy it over here. There's the graphic. And
there's a little digging that has to be done. You just go to the area that says sector breakdown, and it gives you that information.
Perfect.
Like I said, it's updated at the end of every month.
Lisa said something interesting, and I think she's kind of on. She's correct here. It says, I thought the S&P and NASDAQ were purposely weighted that way to take advantage of growth, right? They were designed to go up, and that would change as the sectors change. I think you're right, Lisa. I think not necessarily they're designed, they're architecturally built to go up, but they're going to go with what the hot hand is. And, they'll put in, if financials all of a sudden become the real popular thing, maybe a little more emphasis goes into financials. They add a couple more financials to take advantage of those gains. And I think that's why you're seeing such a big surge here, is how many different IT companies have just blown up for the good blow up, meaning they've just shot to the moon, and they've been adding more and more of these indexes over time. But there's definitely a rotation of markets and segments in here. And it's interesting, we talked about utilities. Utilities is one of the worst performers in 2023, but you look at the percentage, it was 2.3% of the overall makeup of the S&P, so who cares?
Yeah, 30% of 2.3%. Okay.
Yeah.
I'm not going to freak out too much about that. But again, to add to what you were just saying, it's important to remember that with the exception of the Dow Jones Industrial Average, most, and I believe the transports as well, those two are price weighted indexes, right? So as the price of the stock changes, that's going to impact the value of the index itself.
Right.
Once a stock reaches a price level where it no longer qualifies to be a member of the Dow Jones, they'll replace it with something else. And more often than not, the thing that they're replacing it with is something that has been moving higher. The same thing is true for the other equity indexes that are market cap weighted, right? As the price of the stock goes up, market capitalization is going to increase. As the price of stock goes down, market capitalization is going to decrease. And so when you look at how financials have performed over the course of this past quarter, they were one of the best performing sectors. And so it wouldn't be a surprise to see that kind of move up the ranks as the overall sector is doing well. And as they go through the process of reconstructing the index, if there are stocks that no longer meet the criteria from a market capitalization standpoint, they will remove those and they will replace them with something else. So it's right. It's not uncommon to see stocks, for instance, that were on the Russell 2000 end up on the S&P 500 and vice versa.
Right. Yep. Get demoted or promoted from the small caps to the regular ones. Next one is, we kind of talked about this a little bit, but maybe we get just more specific. What do you think will be the best performing or worst performing market segments of 2024? So stepping back, looking at that big picture, are there some areas that you look at and go, man, this one's just going to get crushed this year, or oh wow, I can't wait to get on. And let's leave crypto out of it because we know that's going to be the best performing market segment. But what you take?
That'll be an easy thing for me to do because I am not the crypto specialist. I leave that into your capable hands. But I think kind of going back to what we were talking about earlier, financials are probably going to be an area that you want to watch this year. For a couple of different reasons. One, if we do start to see an interest rate reduction from the Fed, if they start to cut rates, that's actually going to benefit some of these financial companies because they'll be able to borrow at lower rates and, of course, lend at a slightly higher spread. So that should help their bottom line. But the other thing is that if we manage to see that the interest rate environment actually stabilizes, but the economy continues to expand, I would keep an eye on industrials and materials. And granted, materials is a fairly large sector, or it's a fairly small sector, but we're potentially in that stage of the economy where those two sectors should benefit.
And
especially if you. Sorry, go ahead.
Yeah, I was going to say they've certainly had a huge run up. I mean, it's funny because if you look at this chart here from the year of 2023, starting back in July, it was just an aggressive sell-off in it and fell, pretty much those lows we saw in October. And then it's recouped all of that in less time than it took to sell off. And while we're kind of hitting our heads against that ceiling, it is starting to look better from the building materials perspective. Well, this is XLB. I could do XLI as well if you want to look at industrials. But, yeah, I think I would agree with you that I think building materials and industrials will probably perform well if we see the numbers continue to look good for the economy, right? If we get to the point next year that GDP numbers are starting to lag a little bit and unemployment numbers are ticking up and, inflation isn't as controlled as thought, then I think that those areas may suffer because you won't get that sort of expansion. At least I don't think so. Maybe I'm wrong.
Yeah.
Let's see, which ones are companies? You're looking at specific ones. Margaret says, what technical indicator do you use to look for deterioration in the market besides what you mentioned here? Do you look at like put and call ratios? What sort of things do you look for to establish deterioration in the markets?
So excuse me, sorry about that. So one of the key things that I do in the Beck report is looking at the sector rotation through the lens of relative strength analysis. So that's one of the first things that I do. So when I look at the market through that lens and through, for each of the sectors, I try to gain a sense as to where we are in the overall market cycle, an economic cycle, and whether or not I should be anticipating, a weaker or stronger market, or which sectors should be kind of showing signs of strength, and then watching those closely to see if that does come to fruition. And vice versa. We were talking about technology a little bit ago and saying how, so long as it doesn't deteriorate, so long as it doesn't break down. So the thing that I would watch is the relative strength ratio. And I would, specifically compare the technology ETF to the S&P 500. And I would watch the technical levels, the swing highs and swing lows as they develop over the course of the year. I'm using primarily weekly and monthly charts when I do this. And I have key levels that if we break down below, that would tell me that, hey, this, again, going back to technology, which is nearly 30% of the S&P 500, if that breaks down, the rest of the sectors could be, going gangbusters, but you're probably not going to see the S&P 500 go up as quickly as what it could otherwise if technology was doing well, right? And that's true across the board. I watch the relative strength ratio for all of these. So consumer discretionary, for instance, this is an area that has not been showing strength. It's not been showing weakness. It's the fourth heavily weighted sector within the S&P 500. So I have levels that if we break out above, that's going to show me, hey, there's strength, there's rotation into the sector, and we're expanding, and vice versa. So like right now, as I look at it, I know that financials are improving. So that's key because that's the second most heavily weighted sector. XLV, although is probably more of a defensive move here over the course of the last couple of trading sessions, people just kind of seeking safety because staples, utility, healthcare tends to be defensive areas.
Yep.
But what I've seen is that we've come back down towards the lower end of a relative strength channel. And so there's the possibility that if we do see the reversal of the downtrend that's been in place on that over the course of this past year, if we manage to get above a key level, then we could see not only the change in relative strength, but again, broader participation. And so now you've got, possibly 2 out of the top 3 or possibly 3 out of the top 3 sectors within the S&P, moving all in the same direction. So that's one of the key things that I watch. The other that I tend to pay attention to would be things like the percent of stocks above their 50-day, 200-day moving average. I also look at the percent of stocks above their 20-day moving average. That's more of a shorter term indication. So where we are right now, we're very overbought in the market. So the way that I would internalize that is I would say, okay, should I be aggressive, like quote unquote, backing up the truck and loading up to get long for 2024 at this point? No, not right now. What I need to see at least is for the 20-day, the percent of stocks above their 20-day moving average pull back down below a level of 30 to even become interested in joining the trend that started in late October. What's also kind of interesting about this from like a timing perspective is that when you look at the percent of stocks percent of stocks above their 50-day moving average on the S&P 500, that became oversold going into September. And then the percent of stocks above their 200-day moving average became oversold going into late October. And so those were some pretty good signals that, hey, you should be looking for downtrend reversals. You should be looking for areas of demand to get long in the market. So right now, where we are, we're just overextended. So I wouldn't necessarily look to do that. Now, in terms of using it as a leading indicator for a market top, they're very bad at that.
Yeah.
So I wouldn't necessarily look for that. If you really wanted to kind of get down into it, and I don't, this isn't something that I practice all the time, but if you are applying things like the relative strength index, looking for divergences, specifically on like your daily to weekly time frames, that could kind of set you up in a way to say, hey, this market is kind of losing some of the steam for now. But, as far as like using as a signal to go short in the market, I would have to see some key technical levels broken. So like right now on the daily chart, key level that we have on the S&P, and I always look at the cash index. SPX. So that 46.97 from Wednesday, December 20th, that's going to be a key level. At least in the short term. When you start to look at it from a longer term perspective, your next key level is all the way down at 4103, where that whole thing started. So in essence, we're in this big range. And I was looking at this earlier today. If you apply things like Fibonacci and you look at like a Fibonacci retracement, and this kind of goes back into, market expectations, even a 23% retracement of the rally that we had from October going into this highs would be about 3%. If you look at like a 38% retracement of that move, that's like 5% from the high that we had. 50% retracement would be like a 7% decline in the market. 61% would be like 8% from the highs. And that would actually bring you back down to where it is that we broke out from, the highs there in mid-October.
Yep.
So of all of those levels, I would probably say that's going to be a key one. Of course, we also had those highs from July, so that kind of lines up in between that 23 and 38% retracement. So, as I go through and I look at the market, I like to use Fibonacci extensions more than I do Fibonacci retracements. But if you are going to use the retracement tool, looking for kind of those key areas of consolidation that line up with the Fibonacci retracements, they tend to be, I don't want to say magnets, but areas of interest, if you will. So of these, I'd be watching like that 38 and the 61% retracement here, which, that could be a bit of a change in short-term sentiment, especially compared to what we saw in October or November, December.
It certainly feels like there's a bit of just over-optimism in the tail end of the year. I mean, granted, there's usually a nice move up, but this was just a bit absurd. Big Ed was saying that the Santa Claus rally is dead on arrival this year. Yes, no Santa Claus rally this year, guys. And typically, we mentioned that the Santa Claus rally is the last 5 days of the year. Let me get this off here just so I can show you. Statistically, Santa Claus rally last 5 days of the year. and also going in the first 2 days of January, which would have been Friday, December 22nd, to where we closed at today, and that would put us down 1.03%. So this was a bah humbug Santa Claus rally. I'm going to bring on Jeffrey Hirsch of Traders Almanac next Monday. We'll talk about statistics like, as goes January, so goes the rest of the year, and he'll give you a bunch of stats on that one. But not a very good start, kind of a bad omen to 2024 with the current action of the S&P 500. But then again, I love what Scott said at the very beginning. His biggest challenge for him is remaining flexible. When we look at these things like, the Santa Claus rally, or sell in May and go away, or as goes January, so goes the rest of the year, they're all mantras for a reason, because statistically they have worked more often than not. But that doesn't mean that they work all the time. So, got to be careful on these ones and play it by ear and be flexible as we go. Last one I'll get you so you can wrap up here. And that is, you've already said it, but you didn't give a time. You said you were looking at 6120 on the S&P. How about by the end of the year, right? You could be the winner of 2 TraderMerlin shot glasses. I mean, I know that means so much to you. If I were to put your feet to the fire and say, what do you think we'll be at on the final trading day of the year, what's it going to be?
Gosh.
Pressure's on, because I've got a whole list over here. I'm putting you on the list officially. So
Ready for this?
Yep, let's do it.
All right. So pull up a 12-month chart of the S&P 500.
Monthly candles?
Yeah, no, not monthly, but it's the 12-month, so it's like a 1-year chart.
Oh, okay.
Right? So like each candle is 1 year.
Gotcha.
And when you look at what the S&P 500 has done basically for the past 3 years, we're just sideways.
Yeah.
Right. So, I'm going to go with
Unchanged.
Unchanged.
Okay, so
right.
we started.
I think what's going to happen is that we'll hit that 6120 and then we'll retrace back down to 4700. How about that?
I've got 4769 is where we closed at the end of the year, so that would be unch.
Yeah.
Okay. Yeah. All right, I got you. And let's see if anybody else has unchanged as well. Close to Economy has 4800, so pretty darn close there. All right. There we go. Well,
is this like one of those closest to the pin kind of games?
Yeah. Whoever, it's not close without going over. Just whoever's the closest gets these 2 shot glasses. I don't have a picture here. Michael Gong sent those to me, so thank you very much, Michael. Excuse me, something in the wrong pipe already. He sent me a box of them, so I will dole those out over time for different prizes as well. I'll see if I can get a picture of it. For the viewers out here. Michael got a couple of those because he won it last year, so congratulations, Michael. Wow, something stuck in my throat. Sorry about that, everybody. Scott, what's on your plate? I know you're always doing so much stuff. You got XLTs and your general sessions and your morning stuff, but just walk us through a little bit about where people can find you and become involved with what you're doing, teaching, and see what's going on in your world.
Yeah, that's pretty much it. Most of my time is devoted to the mastermind community in the mornings, producing the daily market overview, doing the broadcasts, Monday, Wednesday, Friday. Next Wednesday, I believe it is, I will be hosting a monthly market overview. So kind of giving an abridged version of the Beck report. So I'll be doing that. But outside of that, that's pretty much it. My commitments are pretty early in the morning, and that gives me the rest of the day to do what I need to do in the markets. Well,
and trading is the key thing for you, so I'm glad you have more time for those.
Me too. Yeah. Me too.
All right, Matt. Well, thank you. I appreciate you coming on today. I know it's late over there. You're probably looking for a happy hour somewhere, so I appreciate you taking the time. I'm gonna bug you to get you on maybe once a month or once every other month to kind of give us some updates here. But unchanged for the year is Scott's target for the S&P. I appreciate all that you do, my friend. Thank you so much for coming on today.
Same. Take care.
All right, take care. Guys, Scott McCormick, CMT. You can find him in the mastermind community. He does a ton over there and just great content. Always trying to help people understand how these markets work. And I think that the stuff we just went through, very different than yesterday's show. And I like it because I thought in doing this, it would be a mistake. Initially, I wasn't going to do it. And I'm labeling every show for the next 2 weeks, 2024 market outlook with a specific trader. And the reason I like it is everyone's going to look at things slightly different. I'm going to try to interject less and let the viewer or the guest take it where they think it needs to go for their story and purposes. But interesting. Scott obviously identifying the volatility. Notice that he didn't mention the election one time. I thought that was interesting. Yesterday, that was Brandon is saying, for him, the election is a big wild card. For Scott, he's like, just remain flexible. And when he took that first question, which I asked was, what's the biggest challenge in 2024? He immediately internalized it and said, for me, it's about remaining flexible. I agree. I think we all have to have that because who knows how the heck this year is going to go. I think it's going to be very volatile. I think there's going to be a ton of opportunity, both long and short this year. But yeah, just remaining flexible. He also talked about different market sectors that he thought would be good. I didn't get a bad performing sector out of him, but he talked about, industrials and materials. If we continue on this path that we're being told we're on, which is things are looking better, markets are looking better, inflation's under control, GDP's growing, unemployment is stable. With those variables, that does translate into expansion, and industrials as well as building materials should prosper in that one. So he was focusing on that one. I found it interesting that he said also financials, looking at things like XLF. I'll bring up that chart right now. Let me get away from the yearly time frame. I'll go to XLF here. XLF certainly been floundering for the past 3 weeks, but you notice as this market's been selling off, financials have actually been holding pretty steady. You look at wow, I had a lot of marks on my XLF here. If you look back earlier this year, when we had the banking crisis, not this year, last year, when the banking sector just completely fell apart, you saw that back here in, let me go further, there you go. Going back into March, when we had this giant meltdown, right here in March, at the end of March, I wrote an article called The 3 Bank Stocks I'm Buying Right Now. And that was Bank of America, Charles Schwab, and JP Morgan. Well, Bank of America has done okay since that point. I mean, from the time I wrote that article, Bank of America is up about 21%. You look at Charles Schwab, which I thought would be doing a lot better than this, but it's really not. I forgot exactly when, but it looks like Schwab is up about 23%. But look at JP Morgan. JP Morgan, because of their I think personally because of their connections with the Federal Reserve, because of their power and clout, 34% gain for JP Morgan since that period of time that the banking crisis was going on. So lots of opportunity there. But his comment about if rates get lowered, then the banks can borrow money at a lower rate, and if they keep the spread wide, that would translate to more profits for them. So things looking pretty good. Scott seemed to be rather bullish on the market. I did put on the SPX here. I don't know if you guys saw that one. We'll bring it up here. SPX. I did put a mark on his target, which is it's off the screen. Where was it? It wasn't off the screen. All right, I'll have to put it back on the screen. It was 6120 is his long-term target for the S&P. And here's the thing. I guarantee that he's right. At some point in time, the S&P will hit 6120. I just don't know when it is. So there's Scott's mark, 6120. And I'll even add to that just the date that he made this call, and that was 1/3/24. There you go. And I'll put Scott on that one. There you go. Just so we have it for documentation purposes. There we go. Scott, we'll put you right up there. Bam. Okay, cool. You should do a follow-up article on these 3 stocks, show how good your research. Nah, I don't know. I mean, look, at that time, Margaret, it was catching a falling knife. Everyone thought the world was going to go to hell in a handbasket. So those obviously ended up being pretty nice. The one that's really funny for me, since I haven't made any new trades this year, but I do have an existing trade on with Walmart. You guys remember with the Walmart trade, I thought, hey, we're probably going to do pretty good here. I was happy to own Walmart long term. I am still long Walmart at 155, and I'll bring up the chart here. Walmart, WMT. There we go. And that's the hourly time frame. Here's your daily of Walmart. It's been a pretty nice move up off of that just meltdown over here when it fell down below 150. I actually thought we might fill this gap at some point, but I just sold the 157.50 calls against my long position. They were at the money. I sold those a couple days ago, and right now it's not looking good. And it's funny because I was expecting this market to sell off. I really thought the markets were going to take a little bit of a nosedive here. Look at the S&P. nice rollover for 3 days. The NASDAQ, great rollover for 4 days, and actually feels like it's picking up momentum and becoming even worse. You could look at the Russell, which has had just a giant sell-off. But old Walmart, the one that I thought was going to sell off, which is why I sold those calls at the money, performing pretty well. Dang it. Hate when that one happens. Which sectors did he like, and a few of the companies did he say any of them? No, Michael, Scott is not. Scott's one of these guys that traders come in all shapes and sizes, right? So there's a lot of my guests I'm going to bring on. They're going to focus on individual stocks. The guest I had today is not one of those at all. Occasionally he might focus on a single stock, but he's a longer term person, and he's going to buy into an ETF for a sector. So he'll trade those 11 sector ETFs. So when he looks at industrials, he's not picking one company out there that he thinks is going to be the best or worst. He's saying, I'm going to go with the whole basket to reduce risk because I don't have single stock exposure. Same thing with building materials or financials. We could go through and pick one of the 70 or 80 financial firms that are in XLF. Or you could save yourself all that time and effort and just buy XLF if you thought financials were going to perform well. So today's guest, not one of those ones that actually mentioned individual stock names. I think he did a little bit just when we were talking about how indexes were constructed, but he doesn't really trade individual securities. It's more ETFs that are diversified. That's exactly right, Koja. It's going to hit one day. It will hit one day. 6120, the S&P will hit that. Could it hit this year? Well, let's go over to my list here. 6120 would be about a 30% gain. Actually, about almost a 28% gain. Karen actually has 6150 as her target for the end of the year. So Karen, I got you in here, and that'd be a 28.69%. I did something different this year, guys. I just put in your forecast for the end of the year. What would it translate to in a percentage gain perspective? And by the way, I've got some new people here today, just so y'all know what's going on. I do this every year. I will probably give it another week. And what it is you give me what you think the S&P SPX will be by December, the last trading day of the year. And whoever's closest, I'll send you over to TraderMerlin shot glasses, which I will bring some up here and show you those shot glasses here. I will close out at 6120 this year. Yeah. Yeah, I would too. I don't think we're going to get there, but you never know. What happened to DG today? Don't know. Didn't look at it, but I can bring up a dang chart of it. Well, typically there's news associated with it, but I don't know exactly what happened at Dollar General. But not, it's only 6% slide. 6.5% slide is really not that big of a deal. Some news came out. Not sure what that one was, Michael. No clue there. Does that mean there'll be a soft landing even though the curve is still inverted? Robert, it's a great question. It feels like we're being pushed to believe the soft landing. If you listen to Harry Dent, who's an economist, and he thinks it's going to be the worst recession in 2024 that the history of the markets has ever seen. He's calling for the NASDAQ 100 to fall 95%, the S&P to fall 80%, and for housing market to fall 55%. I think that's crazy talk. I don't think you'll see the NASDAQ fall 95%, but you look at what the Fed has done, what the Treasury has done, the printing of money in the U.S., there's just no way we can get out of this without a problem having occurred. Meaning you printed so much money, you stimulated the market so much, everyone right now is just getting drunk off of free money from the Treasury and the Fed and our government. At some point you got to rein that in, and that kind of contraction of money supply is what Harry Dent has all freaked out about. But it's a tough one. Statistically, the markets move up 7% during a presidential year, which is why I chose the number that I did. And I do expect there to be more volatility this year than last year. I think you're going to see a lot of really wild action, and I'm okay with that. I prefer markets that are really volatile because you get extremes, you get emotion, and to me, emotion translates into more profits. All right, I didn't plan on doing an hour show today. I got 4 minutes left before I got to exit because I don't want to do hour shows. Last place here was Bitcoin. By the way, I don't know if you guys saw the tweet that came out from Jim Cramer. Jim Cramer was on CNBC, and he capitulated. He finally said Bitcoin cannot be stopped. It's not going to go away, and he's bullish on Bitcoin. And all of a sudden, Bitcoin took a 5% slide today. Thank you. The curse of Jim Cramer is unmistakable. Unmistakable, the curse of Jim Cramer. If he says something, it's the kiss of death. What we should do is we should all petition and send in money and just say, Jim Cramer, please say on TV that there will never be a cure for cancer and there is no way that we will cure hunger for the world. Because what will happen immediately is literally the next day we will develop the cure for cancer and there will be no hunger in the world. You just say the opposite of what we need and then what we need will happen, Jim Cramer. Please say we'll never cure cancer just so we can fix that thing. It's unbelievable what this guy's curse is. If he says something's bullish, it goes down the next day. If he says he's bearish, it's going to go to the upside. I know, Big Eb, Bitcoin is going to crater. It's comical. It's unbelievable. Yeah, Lisa said, I cannot believe that Cramer is allowed on TV. Not only that, but if I was so colossally wrong on a daily basis, I would say this career is not for me. I'm not cut out for this. I'd feel embarrassed knowing that thousands of people followed me and got murdered on my calls. Just unbelievable. Just crazy. But anyway. All right, let me run through these real quick. I got to get out of here. So Bitcoin is your worst performer, down almost 5% today. But look, we still are trending up. If you go to the bodies, not the wicks, but go to the bodies, we're still moving up here. I'm not worried at all. Russell 2000 was your big loser, closing almost near the dead lows of the day, down 2.7%. I don't see anything stopping this until we get to 1886, and that means at current price, from where we are right now to 1886, you're looking at a slide of roughly, let me get the numbers exact, hold on, about 4.5%. So it feels like there's another 4.5% downside for the Russell 2000, just based off of nothing there on the daily to stop it. Gold down 1.4%, big red candle there. I am optimistic that it's not going to get below this 2030 mark. If it does, you're going to end up closing that gap, and we could see it's back on this yellow box on gold, which brings it all the way down around 1987. NASDAQ down 1.0%, tech continuing to pull this to the downside. Two big red candles back to back. Similar picture to the Russell. I don't see anything really stopping it till we get down to that 15,897 mark, which from current levels would be significantly lower, to the tune of about 3.9%. There we go. Let's see what else we got. S&P was down 0.85%. This is the most important one. Notice where we are right now. We're just sitting right at those lows we established a couple weeks ago. I'll put a red line right across those lows. We get below that, we might end up closing this gap that started on December 8th. This would not be a good one. It's a long ways away. Gold to me is like Apple to you, Merlin. Sorry, Lisa, that's not a good thing. Your 10-year today. All right, so 10-year has had these two long topping tails back-to-back days. Today, showing a little bit of a red body, but not much of a change on the 10-year. Nothing to be said there. Dollar index was up 1.1%, following through from that giant spike we had yesterday. Again, the more this goes up, the more pressure it puts on the equity markets. And I had anticipated it continuing to fall, getting down towards this $1 level, or 100 level. But right now, a nice big rally for that dollar index, which is punishing our markets. And finally, crude oil, 3.3% gain today, but not changing the overall trajectory of this one. It does still feel like we are going to be going down on the NASDAQ, or on the crude oil. All right, I know I got 1 minute left. Thursday, for tomorrow, ADP non-farm employment change. You also have unemployment claims, natural gas storage, and crude oil inventories. That is it. And I get to wrap up before I do a 1 hour show. If you guys have a forecast, a guess for the S&P 500 and you haven't submitted already, email me at TraderMerlin@gmail.com. Put it in there or put it in the chat here real quick. SPX by the end of the year. Tomorrow's guest will be David Warner. We're going to talk about the global markets, Forex, currencies, etc. like that. So if you guys have questions for David Warner or myself, send them on in. I will see you guys tomorrow. It's the first official 1 hour show of 2024. Take care, everybody. I will see you guys tomorrow.